Four of the largest companies on Earth reported earnings on the same afternoon, and Wall Street sent them in four different directions. That split is not random. It is a precise X-ray of where the AI infrastructure build-out is actually paying off and where it is still a promise. Start with Alphabet. Google Cloud revenue came in at $20 billion for the quarter, up 63% year-over-year, against a street consensus of 47%. The cloud backlog nearly doubled sequentially to $462 billion. Operating margin reached 36%. Alphabet shares jumped 8%, booking their best monthly gains since 2004. For the first time, the market treated AI spending as confirmed revenue, not speculative infrastructure. Amazon told a similar story through AWS. Cloud sales grew 28%, the fastest pace in 15 quarters. AWS revenue reached $37.6 billion at a 38% operating margin. CEO Andy Jassy pointed to a record $364 billion backlog, and that figure excludes the $100 billion Anthropic commitment not yet formally booked. The implied message: demand is so far ahead of capacity that every dollar spent has a reservation attached to it. Meta and Microsoft ran into a different wall. Meta raised its full-year capital expenditure guidance to a range of $125 to $145 billion, a $10 billion increase at both ends, while revenue grew 33%. The problem was sequencing. The spending increase arrived before a proportional revenue payoff, and JP Morgan downgraded the stock to neutral the same day. Meta fell roughly 10%. Microsoft signaled $190 billion in 2026 capital spending, and even though Azure grew 40%, shares dropped 5%. Investors are applying a simple test: show the backlog or show the margin. Both Meta and Microsoft showed neither with enough clarity. When all four reports were tallied, the estimated 2026 capital expenditure across the top hyperscalers moved from roughly $670 billion to $725 billion. The AI spending arms race did not slow, it accelerated. The market's verdict is not that the AI trade is over. The verdict is that execution quality now determines which side of the trade you are on.
While the earnings debate played out in real time, a separate stress fracture was widening underneath the U.S. economy, one that the tech earnings managed to briefly overshadow. March PCE inflation came in at 3.5% year-over-year, up from 2.8% in February. Core PCE, the Federal Reserve's preferred gauge, rose to 3.2%. The driver is not mysterious. Iran war disruptions have pushed WTI crude to nearly $100 per barrel, a 9.7% gain in a single week. Energy costs feed directly into transportation, logistics, and manufacturing, and those costs are now visible in consumer prices. The Federal Reserve held its benchmark rate at 3.5% to 3.75%. That decision was not unanimous. The vote was 8-4, the widest dissent margin since 1992. Four governors signaled they would prefer a rate increase, not a hold. That kind of internal fracture is a signal the bond market cannot ignore. The U.S. Treasury Series I bond rate climbed to 4.26% as inflation expectations repriced. U.S. national debt, simultaneously, crossed 100% of GDP for the first time since World War II, a fiscal threshold that tightens the Fed's room to maneuver without triggering a bond market reaction. Rate cut expectations did not just fade, they reversed. Global brokerages began pricing in a longer period of Fed restraint, with some models pushing the first cut to late 2026 or beyond. The incoming Fed chair, Kevin Warsh, faces an immediate credibility test, inheriting a split committee, an inflation problem rooted in an ongoing military conflict, and a debt level that makes aggressive easing fiscally complicated. The Iran oil shock is the linchpin. If the Strait of Hormuz remains under pressure through June, energy prices stay elevated. Elevated energy prices keep PCE above 3%. PCE above 3% keeps the Fed on hold or moving higher. And a Fed that cannot cut, or might hike, is the single biggest constraint on tech valuations that depend on discounted future cash flows. Alphabet can absorb that. A company still building the infrastructure and not yet converting backlog into free cash flow faces a different calculation entirely. The Dow Jones Index rose more than 700 points on the same day, powered by Caterpillar, which beat earnings as AI data center construction drove demand for power and heavy equipment, and Eli Lilly, whose GLP-1 drug franchise posted $19.8 billion in quarterly revenue, up 56% year-over-year. Industrial and healthcare stocks are currently absorbing the liquidity rotating away from the AI capex spenders. That rotation is not a panic. It is a reallocation to companies that are converting the AI build-out into physical demand right now, not in 2027.
The weight of evidence points towards sustained pressure on rate-sensitive tech through mid-2026, driven by sticky energy-linked inflation and a fractured Fed. That leaning holds as long as the Iran conflict keeps oil above 90, and the Fed descent does not resolve towards cuts. If a ceasefire emerges and energy prices correct sharply, PCE could decelerate fast enough to give the Fed cover by Q3, and the stocks that lagged, particularly Microsoft and Meta, would recover first. Watch Friday's non-farm payrolls for the labor signal that the 4 dissenting governors will cite, and watch whether Alphabet's Q2 cloud backlog conversion matches the $462 billion pipeline. If the conversion slips, the one company the market is currently rewarding most becomes the next test case.